Hi, my name is Untitled, and today we're going to have a lesson about option Greeks. Now, if you've traded a few options, you're probably battling to understand why your trade's unprofitable. You start to realize like trying to predict what will happen to the price seems to be nearly impossible. Why is that? Maybe you've traded some futures before and you've made some money. Why it's so hard to do the same with options? You experience the forces in the market and you're trying to see that if the price of a future goes up, sometimes the price of your option goes down. Why is that? It's counterintuitive to what you've been used to trading. If you've done a previous lesson, the lesson on options, you should have learned about the Black-Scholes equation and the parameters that influences an option's value. There's 4 parameters that you should know by now. Those are the value of the underlying future, the strike price, the time to expiry, and the volatility of the underlying futures contract. 4 parameters that we need to get to know. If you've done some wider reading and maybe you've traded some warrants on the stock exchange, you would have noticed that I left out 2 parameters. That is the dividend and the interest rate. Why is that? The reason is that the options that you trade on Safex and YieldX are options on a futures contract. The futures price already implicitly take the dividend and the interest rate into account, so we don't have to worry about those when you price options on a futures contract. But gaining an understanding of these parameters, these 4 parameters, is vital to understanding options and the trading in options. Now, when we talk about these variables, that's when we talk about Greeks. Now, maybe you've heard about somebody mentioning something about Greeks. They mention something like a delta, a gamma, a theta, and you just think, let's just stay away from option trading because it becomes too difficult to understand. If people start talking Greek to me, I'm rather going to stay away. This lesson is going to teach you that understanding the Greeks is vital to trading options, and it is really not that difficult. And if you understand the Greeks and you understand how they influence options and your view on trading options, you will find option trading a lot easier. Also, something that you need to understand is that if you try to do something like technical analysis on an options price, you will find it doesn't work. Maybe you know about your stochastics and your momentum. These are technical indicators. And you might have done them on option values. You might have gotten some historical time series of options on the Aussie future. And you see, it really doesn't make sense at all. It's also one of the reasons why you need to understand the Greeks. Now, in this lesson, we're going to investigate the following Greeks: the delta, the gamma, the theta, and the Vega. Only 4 of them. These are the basics of the Greeks, and maybe in further lessons we can go into some other Greeks, but you need to understand these 4 to enhance your option trading. First Greek is the delta. The delta is a measure of how an option's value or premium changes given a unit change in the underlying futures price. Basically describes the relationship between the futures price and how your option value will change as the underlying futures price changes. Now, this statement is very, very important, and you can interpret it in 3 different ways. First way is, let's look at an Aussie future, for example. The delta of an option on the Aussie future tells you how much the value of the option will change based upon a 1-point change in the futures market. Now, the delta of a call ranges between 0 and 1, often expressed as a percentage of 0 to 100%. A put would have a negative delta value from -1 to 0, or -100% to 0. And after this lesson, you'll know exactly what that means. Now, a zero delta would have little movement, meaning the price of the option will change very little if the underlying futures price changes. But a delta of a value of 99% means that your option price will change quite drastically when the underlying futures price changes. Now, let's look at an example. And we show this example in the first slide. So look at the slide, look at an example of a March 11 Aussie futures contract. And we want to trade a call option on this futures contract. Now, on the 11th of November, the mark-to-market of this futures contract was 28,436. And the at-the-money volatility of a March option on this futures contract was 19.75%. Now, we calculate the delta to be 52% of this, as shown on screen now. What does that 52% actually means? It means that the option value changes by R5.20 if the futures level changes by 1 point to 28,437. So if you're long this call option, you will gain R5.20 in your options premium. How do we get to that? Look at the last equation on screen. We say the change in the option value equals the delta as a percentage. Remember, that's very important, delta as a percentage, times 100 divided by 10. So if you take 52% times 100 divided by 10, you get to 5.2, which means the R5.20. So it's an actual number, an actual cash value. Now, if we move on to the next slide, the question is, how did we calculate the delta? It's all fine and well. If you have the delta, you can calculate your price change of the option. But how did we get to the delta? Look at the equation. It's actually very, very simple. You know about the Black-Scholes equation to value options. So we say the delta equals the Black-Scholes value, where the Aussie is at 28,437, minus the Black-Scholes value, when the Aussie is at 28,436, divided by 10. So if you look at the premiums, we have a premium of 13,042 minus 13,037 divided by 10. That gives you 52%. So if you have a Black-Scholes options calculator, you can calculate the delta quite easily. If you, for instance, look at single stock futures, and let's look at MTN, for instance, the last example on the slide. The delta will be the Black-Scholes value when MTN is at 131 Rand and 1 cent, minus the Black-Scholes value when MTN is at 131 Rand. That is 545.59 minus 545.94. That gives you a value of minus 35.4% for a put option on MTN. So exactly the same calculation as for indices. Why do we divide the indices by 10? It's because of our point value. Remember, futures on an index, the Aussie index, is 10 Rand per point, meaning if you buy a future at 28,436 and the index increases to 28,437, you would have made 10 Rand. So that is why we divide by 10. On the single stock futures, it's basically 1 cent, the point value, meaning we don't have to divide by anything. Now, if you, for instance, look at the second thing that the delta can tell us about an option, it comes into play if you view the delta as a hedge parameter or a hedge ratio. Now, what does that mean? It comes into play when you talk about delta neutral trading, and then we call it a position delta. Now, the delta is in effect a hedge ratio because it tells us how many option contracts you needed to hedge a long or short position in an underlying. This is very easy to grasp. Let's say, for instance, that you bought 100 of the above mentioned Aussie calls. Strike price is at the money. So you bought the call option because you hope the market is going to go up. Now we've calculated the delta, which is 52%. So if you're long 100 Aussie calls and the Aussie future contract goes up by 1 point, it means you will gain 520 Rand on that position. But what happens if you are wrong in your view and the market starts going down? If the market goes down by 1 point, you will lose 520 Rand. If the market starts going down, you should start to think about hedging your options position. What will you do with your hedge? You either buy or sell the futures contract. Now for a call option, if you bought the call option, you should sell the futures contract. But now the question is, how many futures do you sell? Quite easy. If we know that you will lose 520 Rand on your option contract if the market goes down by 1 point, you should sell as many futures where you will gain 520 Rand. 520, it was 52% times 100, because you have long 100 contracts. It means you should sell 52 futures contracts, because that will give you, with a 1 point loss, 520 Rand on the futures contracts. You will lose 520 Rand on your option contract, but you will gain 520 Rand on your futures contract, meaning you are hedged. So 52%, 520 Rand, it all comes together, so the delta also tells you how many of the futures contracts you should buy or should sell. Now, if you look at the next slide, I've put it out there so you can actually see. There's your 100 contracts that you times 5 Rand 20, meaning you will make 520 Rand if the market goes up 1 point. Also meaning you will lose 520 Rand. So how many futures should you sell? The last equation there is your delta as a percentage times 100, meaning 52, what I mentioned just now. This leads automatically into the third and last way that you should look at the delta. The delta also tells you whether you should buy or sell the future. For a call, we mentioned that the delta is positive. So meaning for our Aussie calls, the delta was a plus 52%. That plus means you should do the opposite, so you should sell the future if you want to hedge that. For a put, like our MTN put, we had a negative delta. So if you long a put, the negative delta tells you should buy the futures contracts. Now, some more points to remember about the delta. The delta is influenced by the strike price. So if you, for instance, look at the Aussie call, we had basically an at-the-money Aussie call. The delta was 52%. If we change the strike to 25,000, meaning we have a way in the money call option, we see the delta changes to 83%. So the more in the money the option is, the closer the delta will be to 100 for a call, minus 100% for a put. If we change the strike for our Aussie call to 31,000, meaning we're moving far out the money, we see the delta becomes less, goes down to about 20%. So far in the money contracts have deltas close to 1 or minus 1. Far out the money contracts, the delta will be close to 0. Let's look at the graph on the next slide. There I show you the graph for a call option. We see that as the strike price, as the market goes far out the money, the delta goes to 0. And then we have the S shape. As we move further and further in the money, the delta goes further and further to 1. Next slide shows us the put value, which is just a mirror image of that. We're going from 0 to minus 1. Now let's look at an example. We look at the next slide. Let's say, for instance, now you were long the put option on MTN. And you had an at-the-money put at 131 Rand. And we show the line there in black. That's your long put position. You bought the put because you were scared that M10 will go down in price. And then you see your view is actually wrong and the market starts going up. And you want to hedge your put position. What we mentioned before, the delta of the put was a negative value, so you need to go and buy the underlying futures contract, meaning you must go and buy the M10 futures contracts. If we combine the two, the long put, and I show the long position on the futures contract in blue, if you take those two payoff diagrams together, we get the orange line. And that is actually just the payoff diagram for a call option. And here you have your first lesson in terms of put-call parity, which states if you're long a put plus long the future will give you a synthetic call option. Now you will learn more about structures in another lesson, so I'm not going to go further into that. Now let's move on to the next Greek, the gamma, also called pin risk. Now you should realize by now that as the Aussie futures level changes, the delta will change as well. Greeks in general are not static. As the market moves, the Greeks will change. The delta is very important. You should have realized that by now. So it's very important to understand from a trading perspective, if the delta changes, by how much will it change? Because we've seen now, it tells you the delta, how many of the futures you should buy or sell to hedge yourself. So you should actually know, if the market changes by a certain amount, how much will my delta changes? We call that dynamic delta hedging. Now the gamma tells us how much the delta changes as the underlying future moves. So the gamma measures the rate of change in the delta for each 1 point increase in the underlying future. It is a very valuable tool in helping you to forecast changes in the delta of an option or an overall position. It is used to let the trader know how smooth the delta will be. A small gamma means that the delta will stay relatively flat during small stock moves, where a large gamma means the delta will change sharply during the small stock moves. If the gamma is small, it means that your hedge position doesn't have to be adjusted very often. While if the gamma is large, your hedge position should be changed quite often. Now, gamma is the largest for at-the-money options and gets progressively lower for both in and out-the-money options. One thing to remember where the gamma is very, very useful is if we're very close to expiry and the underlying futures market is close to your strike, the gamma can become very, very large. And that is where the term pin risk comes into play. Think about how the structure of the Safex market works. On closeout date, from 12:40, closeout starts. However, you're sitting the whole morning, it's a couple of hours with an option. And let's say, for instance, now that you have a strike of 28,000 for a particular option, and the future currently, the morning of closeout, is at 28,010. Your delta will be very large. And you will see your delta actually swing from 0 to large, meaning your delta goes from 0 to 1 in an instant. Because you don't know whether your option is going to close or expire in the money or just out the money. Very tricky situation for any trader, but at least the gamma can help you to see what will happen in the market. If you look at the next slide, I show you the graph of the gamma for an Aussie put option, showing you just that gamma is the largest for close to the strike, and then it tapers off to 0. We're not going to talk about how to value a gamma or get the gamma value. It becomes quite involved, but I'll show you a trick later on in this lesson. So let's talk about the theta. That is the race against time, the next Greek that you should know about. In a previous lesson, it should have been mentioned that options loses value as time progresses. And this is known as the theta. It measures what we call the time decay. Every option has time decay. If you look at the graph, there I plot on the x-axis the dates to expiry for our March 11 Aussie option, and then on the y-axis the time value. And you can see we start off now where the time value is relatively small, but as we get closer and closer and closer to expiry, the time value becomes increasingly larger, and very close to expiry it just runs away from you. That is shown by the curvature, and you see the blue line going down. We see from this example, which is an at-the-money Aussie put, from about 1 month to expiry, the theta or the time value starts running away from you. And one needs to understand what the time value is and how to actually use that. Now theta, from this graph we see theta is the constant enemy of an option buyer. As time value leaves an option every day, that is very important to understand. It leaves the option every day, no matter what direction the underlying futures price move. So your option might move in the money, but you're still paying away theta every single day. And you can see from the graph, if you go back to the graph, closer to expiry, the more theta you will pay away. Now, many times people pick up options and then forget about them. Now, even though the market may move in their favor, the theta can eat away at the option's value. So it's very important to take that into account, especially if you get closer to expiry. Now let's look at the next slide. The question is, if it's so important and we need to take cognizance of it, how do we calculate it? I show you the equation or the formula in the slide. The theta is just the option value tomorrow minus the option value today. So again, if you have your Black-Scholes calculator, you can calculate the theta quite easily. Let's look at our MTN example. We have a March 11 MTN put. Currently the value is at 131, and let's say the strike is 125. We calculate the option value tomorrow, and remember we have an equation, it's Black-Scholes, so we can adjust the date as we wish. So you will see that the option value tomorrow is 542 Rand and 76 cents. The option value today is 545 Rand 94 cents. Subtract the two from one another and you get a value of minus 3 Rand 18. That is a Rand value, meaning that every day your option value will decrease by 3 Rand and 18 cents. Now, there's a relationship between the theta and the gamma. And this is maybe scary for some people. Next slide we show this relationship between the theta and the gamma. So this formula can be used to calculate the gamma. If we have the theta and we have the futures contract. So theta equals to minus a half times the volatility times the futures level times the gamma, where sigma in this case is the volatility and F is the underlying futures price. So you can just invert that equation and you can get the gamma level out from that. This shows you the direct relationship between the gamma and the theta. Now, when the options gamma is high, the theta moves higher as well because of the direct relationship. When we say higher, it actually means the theta becomes more negative. It's a bigger number with a negative sign in front, meaning you will lose more time value. Now, some option traders will actually play the high theta by selling shorter term options and buying the same strike options for a longer maturity or a longer expiry date. They are banking on the fact that the longer dated option will have slower time decay than the shorter dated option. So you can use the theta in a trading strategy. In the next slide, I show you the theta as the underlying futures level changes. This is just again going back to our March 11 Aussie call. You can see again around the strike price, theta is the highest, and as we move away from the strike price, theta becomes less and less. So just take note of this. Now, the last but not The least important Greek is the Vega. Very, very important. Also called the fear factor. Also previously in a lesson you've learned about volatility and the importance of volatility for any option trader. Now we call Vega the king of all Greeks. Why? Because any option trader is actually a trader in volatility. If you buy an option, you're actually buying volatility. Why do we say that? If you buy an option, you bank on the fact that volatility will go up. If volatility goes up, your premium goes up as well. So the underlying futures level can stay exactly the same, but if your volatility goes up, your premium will go up as well, and you can sell your option for a profit. Now the Vega measures the impact of volatility changes on the price of the option. And it's usually measured by changing the volatility by 1%. Do not confuse the Vega with volatility. Volatility measures the fluctuations in the underlying asset, while Vega measures the sensitivity of the price of an option to changes in volatility. So if you just want to refresh yourself, go back to the lesson on volatility, quickly go through that to understand exactly what volatility is. Here we want to understand what the impact of volatility is on an option's price and how we can manage that. A change in volatility will affect both calls and puts in the same way. An increase in volatility will increase the prices of both calls and puts. And a decrease in volatility will cause all options to decrease in value. Now, each individual option has its own Vega, which is also dependent on the strike price, meaning the impact of volatility changes is greater for at-the-money options and is less so for in or out-the-money options. So if we look at the next graph, I plot the Vega for an Aussie put option. And there we can see the first one is an at-the-money option. You can see the Vega is the biggest around the strike price. And I also plot the red line, a Vega for a slightly different strike price. You can see again, around the strike, the Vega is the highest, but it might be higher than the previous example. Beware of buying options when there's a high Vega, meaning that as the volatility changes, your option value will change as well. So if you have a high Vega option, look at the volatility and get your own view as to where volatility will go, either up or down. If you buy a call option already at a high volatility, it will have a high Vega, meaning you can make a lot of money if volatility goes higher, but your option value can collapse if volatility goes lower. Now, how do we calculate the Vega? We look at the next slide. Similar as to our theta formula, we say that the Vega is the option value at the current volatility plus 1% minus the option value at the current volatility. So let's look at our MTN put. We calculate the value when the volatility currently for MTN was 27.5%, the at-the-money volatility. Calculate the option premium when we add 1% to that, meaning volatility goes to 28.5%, we get a premium of 574 Rand and 15 cents. And we calculate the value at a volatility of 27.5%, subtract the two from one another, and you get a value of 28 Rand 21. Meaning, if you long that one MTN put contract, volatility goes from 27.5% to 28.5%, your option premium will gain 28 Rand and 21 cents. If volatility goes down by 1%, you will lose that amount. What have we learned in this lesson? 2 points that you should take away with this lesson with you. First one is, the Greeks are risk measures that can help you choose which options to buy and which to sell. With options trading, you must have an idea of the direction of the underlying, as well as a view of the direction of implied volatility, and then factor in timing. Second point to remember, the Greeks help you tailor your strategy to your outlook. Understanding the Greeks gives you even more of an edge in this zero-sum game of option trading. Thank you.